Fed keeping its forecast for 2 rate cuts this year, but saying uncertainty around the economic outlook has increased. Joining us now, Bill Eigen, Chief Investment Officer of the Absolute, is it sponsored by the vodka? The Absolute Return, Absolute Return, I'm sorry.
Yeah.
Fixed Income Group.
That's where your mind's at.
That's where my mind is.
In the morning. At
JPM Asset Management. You either, just from looking at your notes, you either think it's not going to happen or it's a mistake for 2 cuts.
Yeah, well, I think 8 Fed members told you yesterday that they just reduced their forecast to 0 to 1 cut at most. And so the details of yesterday's statement were a little more hawkish than I think the market interpreted. And I was kind of laughing at the reaction. And even today, sending 10-year Treasury yields lower, I think it's interesting. I mean, I was on here in December and the 10-year was around 4.10. I said I don't like it. Went to 4.80. Still didn't really like it because I still could get almost as much in cash as I could in 10s at that point. And today, you can get paid a lot more to own the short end of the yield curve than you can to reach out and extend out to 10 to 30 years. Why would I do it?
We've had cool inflation numbers, but you say we're in a secular period of inflation.
I think so. I mean, you have seen inflation come down, not anywhere close to the Fed's target, mind you, but it's come down, but now it's starting to move back up again, including the inputs to PCE, which are looking not so good going forward. Looks like they're going to keep moving up. Obviously, tariffs are not disinflationary or deflationary.
Are they inflationary?
To me, they are, because I'm seeing it directly.
Not transitory.
I hate that word.
I know. Everybody hates it. It's a okay.
I thought that word was extracted from
just because they screwed up. But okay, so is it something that tariffs cause permanently, or is it more just a temporary increase in the price of something?
I guess if they stay in place permanently, then you kind of have a permanent increase in inflation, right? I guess it depends on.
That'd be a one-time thing, though, right?
Forever.
Yeah, fine. Well, fine, but inflation is the second derivative.
Right, so you get this big bump, and you're saying, but then it just stays there.
Then you go to Harvard.
Doesn't move up again. The bottom line is, a couple things going on here right now, right? People say, oh, the Fed's restrictive, this, that. And I just look at it, I'm like, well, if the Fed's restrictive, then why has the economy grown so well over the past couple of years? Why is inflation way above their target? Why is unemployment hanging at 4%? Jobless claims are in a great place. The labor force is getting thinner, if anything. Employment costs are moving up. Service costs are moving up. You've got gold, silver, copper, all at the highs, right? And those are all inputs into the manufacturing process. So I look at that and I don't feel so great. And I'm not trying to be a big bear here saying, oh, my goodness, look out for the hyperinflation. No, that's not what I'm saying at all. All I'm saying is I think inflation is settling in at a level that's way, way above where the Fed's comfortable. And it's going to make it very difficult for them to make decisions around, oh, geez, we really need to ease rates here, even if the economy slows to some degree.
So if the president's already job owning for lower rates, he's going to be disappointed.
I think so, if the Fed's to remain truly independent. I mean, but what's so restrictive about where rates are? I keep asking that question. And the other question I have is, why does the Fed still have close to a $7 trillion balance sheet, which is 3.5 times the size it was during the crisis of 2008? The whole bond market's $50 trillion. Why do they feel the need to hold $7 trillion of it?
I mean, I guess, we live our life and we get over all these horrible things that are happening. But like someone said the other day, none of us are leaving this place alive. All right. So can we ever declare victory that the Fed orchestrated a soft landing and we put that behind us and now this is a new problem we have? Because if inflation is still where you say it is, it's still going to rear its head. Then they didn't do it. They left too much in the pipeline. They didn't fix it. And that would be premature to say that they did everything perfectly.
I think they need to adjust 2 things. I think number one, they need to adjust what they really feel the neutral rate is. Maybe we're at the neutral rate now, right? Maybe we are. We don't know. I mean, everyone insists it's way lower because we got so used to this zero rate regime, which caused all the problems that we've dealt with, in part over the past few years, including the significant inflation we've seen.
So why isn't this a good thing with DOGE and with tariffs coming in? Why isn't it good that the economy is so resilient?
Oh, don't get me wrong. I think what the administration doing longer term is going to be great. I think it's going to be very good for business. I think it'll be good for risk. But the things they're doing right now is there's going to be a lot of uncertainty in the short term because of all the things they're doing, whether it's tariffs, whether it's deregulation, whether it's, what we're doing with Ukraine, everything. I mean, first person through the glass door always gets bloody, right? And that's kind of what the Fed's dealing with.
Another good one. I got to write that one.
Yeah.
down, too.
It's very violent, but it's very illustrative. Like, it really conjures up an image. Where do you think the 10-year yield goes? We're at 4.199 now.
Yeah, I know. We're just barely above where it was when I was here in December.
And you said 5% then, right?
Yeah, well, no,
Closer to
I thought, and it almost got there. It went to
Yeah.
480. But it's just been volatile for the past couple of years, right? It's been in this range between kind of the low fours and the high fours for a long time now. And I just think that's kind of where it's going to stay. And which is why, you know, I don't make coin flip bets in my fund, and betting on rates to go one direction or the other, to me, is kind of a coin flip, especially relative to cash, where you can make in 3-month T-bills, you can make.
But we stay in
4
the
and
range is
3/8.
important because the idea that the 10-year yield would go below 4
Yep.
would be really like underscoring the growth scare that we've been suffering.
100%. You're already building in several cuts,
Right.
even the 2-year, which is below 4% with Fed funds at 4 and 3/8 mid, right? So, you know, again, the market's already building in these cuts, even though 8 Fed members said yesterday they're expecting 0 to at most 1.
There needs to be an adjustment.
Yeah, so I
market.
just think you get in these ranges where people get all bullish, the 10-year goes to the lower end, then something comes out and they don't feel so good, and all of a sudden it goes back up to the higher end. So I'm not calling for 6% 10 years. I'm not dismissing it either. The biggest mistake people make in fixed income is they dismiss scenarios, right? As an absolute return manager, I can't dismiss any scenario. I got to make sure I can make money in rising rate environments, falling rate environments. It doesn't matter. But right now, I will tell you, you know, you're at the lower end of the range, and spreads among all forms of fixed income, whether it's corporate bonds, high yield, are near record tight levels. And the problem with that is when you have really tight risk premiums, everything acts like a treasury, right? Because there's no cushion anymore. So you're putting all your eggs in the rate basket, and that's not something I prefer to do.
So you got $20 billion, and what could I expect as a return? What do you shoot for?
Well, so it really depends on what type of volatility patterns we see going forward. I thrive on vol, right? Like, for instance, last week, a couple weeks ago.
Historically, what have you been able to deliver?
Well above the Barclays aggregate index. I think in the 17-year history of the fund, on average, each year we outperform it by, you know, between 1 and 1.5%, which is a lot in fixed income terms. And most importantly, in a year like 2022, when fixed income was down, your average fund was down 10 to 15%. We were actually up 0.5% that year. And last year we were up, you know, 5.4%, while the aggregate index was up just over 1.
Right.
So that's the difference between absolute return investing and relative return investing. A relative return manager in fixed income, where you're never supposed to lose money, right, Joe?
Right.
Could be down 10%. The index is down 11, and they're patting themselves on the back saying they did a good job for you. Meanwhile, you're like, wait a minute, my dollar just turned into 90 cents.